Thanks for joining us today on Market Call. I'm Morello Fernandez. We have a new guest on the show with us today, Tim Regan, Managing Director at Kingwest Company. He'll take your questions on North American large caps. Here's how to reach us. 1-855-326-6266 if you want to call in and ask your question. You can also send an email to marketcall@bnnbloomberg.ca. There's the information for you on the board. Tim, thanks for coming in. Good to meet you.
Thank you for having me.
Let's talk a little bit about the markets being in the doldrums for the past week or so. Markets are typically stronger at the end of the year, historically, that is. So what do you think has investors concerned? Is it just AI?
There's a few things. I mean, the markets have had a great run. You really need the underlying businesses to catch up with it. And a lot is AI and gold. The speculative elements have still been moving in the market, whereas everything else has really been flatlining for the last number of months.
Are you seeing money begin now to sort of balance out a little bit more in other sectors?
I think so, but if it is, this is the very first stage. I mean, we've been waiting for this for a while. But really, the market has to wring out the excess speculation right now.
And you don't think it's done that yet?
No. There's a lot of very pricey companies out there. There's a lot of very pricey assets out there.
Okay, let's talk about earnings season. We have some earnings still to come, but we've had a lot of reporting already. What's your take so far on what we've seen?
It's been an interesting earnings season, because some of those that have disappointed the street, not even, they may have surpassed what the estimates were, have been severely punished. And there have been a few companies that have well surpassed what the analysts thought, but their companies just went up a bit. So you can see that there's a lot of high expectations out there. And I think there is some nervousness out on the street.
When was the last time, if you recall a time, where it was like that, where the companies beat, but investors were with the result?
Well, I'm trying to think back, but what this market reminds me a little bit more of is 99, 2000. And people forget, even though the tech bubble crashed, the markets went down, I'd say probably half the stocks still continued to go up for the next 2 years. So it's really a two-tiered market between things that are overvalued and things that are correctly or undervalued.
What are you paying attention to as we draw to the end of the year, and what do you think investors are looking at for 2026?
Well, I think we're looking for a little more clarity on the tariff side, whether we get it or not. We're also looking for some economic indicators. In Canada, they're coming along. In the States, now that the sabbatical's over, not so much. But I think that's what a lot of people are looking for. Plus, I mean, we'll talk about it today, of course, but NVIDIA's earnings are coming out, and that's really the bellwether for things that have really been running this year.
Do you have concerns about them not meeting expectations, or do you think investors will still punish them anyway if they do?
I wish I knew that I could make a lot more money,
exactly.
but we'll see what happens when they come out. But I think if NVIDIA stumbles and does not meet expectations, it could be a bad tomorrow for NVIDIA.
Okay. Let's take a break. We will line up some questions for Tim Regan of Kingwest Company. He's taking your questions today on North American large caps. Here again is the phone number to reach us and the email if you prefer to email your question and marketcall@bnnbloomberg.ca. Back in a moment. Welcome back. Thanks for joining us on Market Call. Let's start with an email today from John, who says, does the guest have any thoughts on Molson Coors? Our guest today is Tim Regan, and we will ask him just that. Molson Coors, we haven't actually talked about beverage companies, alcohol companies in a little while here, usually a staple. Let's take a look at the line chart. What do you think about Molson Coors' performance these days?
Sure. Well, we don't own it in our portfolio, but one of the reasons being is that's the stock chart, but it's really following the business. And beer consumption around the world, especially in North America, is down over the last number of years. It is a trend that no matter how well Molson Coors can do, they can't fight that trend. They've tried to bring in other beverages, even tonic water,
Mixed beverages, that
mixed
kind of
beverages,
thing.
everything, but their sales are still going down. So when you get a company like this that looks like it's cheap, but the underlying business is really going down, you really want to look at a company like this and let it correct itself. But it's going to be a macro environment of people coming back to beer drinking, which statistics tell us it probably is not going to happen tomorrow.
So do you think it's just people moving away from drinking, period, or people just not drinking beer, for example?
Perhaps a bit of both, but I know people not moving away from drinking, so to speak, but younger people now drink less alcohol per se, but higher quality brands. So instead of going out and having 12 Coors, they'll have 2 very nice cocktails.
Got it.
And that's a trend that's been going on for the last 5 years or so.
Got it. Okay, let's go to the phone lines then. We have our first caller, who is Doug. He's in London, Ontario, with a question today. Hi, Doug.
Hi, good afternoon. I was wondering about TELUS. I'm quite a bit underwater on it, and now with a couple key downgrades in the last couple of days, it's tanked even more. I'm just wondering if I should cut my losses. I'm down about 20%, or would this be a time to add more, thinking that it can't go much lower? I'd like advice. And would you be buying, or do you own this? Thank you.
Okay, Thank you for the question. TELUS in the telecommunications space, which has been a hard-pressed sector for some time, and then it did get downgraded a couple of times. So 1872 is where we are today. The caller, Doug, says he is down about 20%. Would you buy in at this point? I know there's a dividend, and there's some concern about that dividend being paid moving forward. How do you feel about TELUS? Sure.
Well, we own TELUS, and so we're there with you, Doug. But what's happened is it's the threat of perhaps a dividend cut. J.P. Morgan said they can't sustain the dividend. However, in the next couple of years, their capital spending will not be as robust as it was in the past few years. I think they go down from about 17 to 12%. So in the next couple of years, they can more than cover their dividend. Right now, the market really punished it on the news. So we own it. We're sitting and waiting. Perhaps you should do the same. But the dividend yield now it's come down so much. It's incredible, the dividend yield. And they raised it the other day. I think you're looking at 8-9%.
Okay, let me pull that up.
Not a bad yield right now.
I have, yes, you're right, 8.95. So
8.95,
it's a high
so
dividend.
it's very high, yeah.
And you don't feel like it's threatened at this point?
I think it's been beaten down, hopefully as much as it's going to be beaten down. But the underlying business is not a great growth business, but it still has some legs to it.
Okay. All right, let's go to our next caller. Walter's on the line. He's in Kingston, Ontario, with a question today. Hi, Walter.
Hello. Thank you for taking my call. My question is on Canadian Natural Resources. I've been invested in it for a long time through the ups and downs. I've noticed over the last 3 months it's been moving up very nicely. And I heard, I could be wrong, but I heard oil stocks tend to rise before the commodity. And I'm just wondering, would you be a buyer of Canadian Natural Resources today? Thank you.
Okay, thank you for the question. Oil has been stuck around $60 a barrel, in that range. First of all, when we talk about data build-out, and we haven't really seen that enthusiasm go into oil just yet, not even in natural gas really yet. So what's your forward look on oil and CNQ as part of that?
Well, let's talk about CNQ first of all, because we own CNQ, and actually about a month ago we doubled down our position on it. CNQ, as an oil company, is just superb. They are superbly managed. They're a great company. So if you want to look at oil, CNQ is one of the places to be. With oil, I'm going to tell you right now, we cannot forecast the price of oil. It's tough. But oil right now is $60 a barrel. The big thing that's happened in Canada is with new pipelines being built is a spread between the Canadian oil and West Texas Intermediate or Brent has been narrowing and narrowing. And the more pipelines built, the better for it is in the future. And so really, I'm not going to try to tell you where the oil price is going, but if you want to own oil, CNQ is the place to be.
Okay. Do you see it eventually being part of the cycle for AI build-out?
Well, the AI build-out needs energy in some way, shape, or form, whether it's nuclear reactors, hydro, wind power, oil, natural gas. And right now, oil and natural gas, until they build more reactors or more wind turbines, that's what's going to happen.
Okay. Walter, I hope that works for you. Let's go to an email from Millie. Millie says, what do you think of Constellation Software with the recent drop? Do you think it's a good time to buy in some? So Constellation Software, pretty well-known company. A couple of things have happened. One is the concern about the software business in general with the emergence of AI. And then also, of course, they lost their leader who has stepped aside, I believe, for health reasons. So it really has dramatically gone down since the summer. And people are wondering sort of if it'll recover. Is there room for a recovery here? Do you share the same concerns about software?
Well, Constellation Software is a company we don't own, but we have looked at it, and it's active in being looked at. And this is another example. Why didn't we own it? It's just it's priced very highly, even at this level. You know, for us, it would probably have to go down a little bit more for us to buy today. They did have Mark Leonard, who was their founder, step away. People are trying to ascertain whether, you know, in the last 10 years, he was still most of driving the business, or it was other people as well. And so, you know, Constellation is one that right now we don't own. I think it still is trading fairly expensively. And if there's a hiccup in the business, you're going to see it go down a little bit more. But as I like to say, you never know what investors are going to do tomorrow.
Do you worry about the software business and their style of business, which is to pick up other software companies?
No, not really. They've done a great job with acquisitions. They don't really roll up. They buy things that are more monopolistic. So they do a very good job. But at the same time, what you're going to hear me say a lot today, it's all about price in this market today. And you know, we love to buy great businesses or wonderful businesses, but we want to buy them at the right price. One thing I'll say about Constellation, it's a wonderful business. It's a great business. It's just the price.
Okay. Let's take a quick break. We will line up some more phone calls for Tim of Kingwest Company. He's taking your questions today on North American large caps. We're back in a moment. Stay tuned. Welcome back. Thanks for joining us. Let's go to an email from Eddie. He says, thoughts on GFL.to. Is this a buy or a hold? GFL is a waste management company. Is this a company you follow?
We own GFL, and we quite like GFL. GFL is a company that we own it. We'd be active buyers of it if we didn't have enough. One thing about GFL, when I talk about companies being expensive, if you look at the headline earnings, GFL looks expensive. However, GFL, just the nature of their accounting and how they roll up the businesses, is just earning cash flow like it's going out of style. And the waste management business is great. The people who run it are great at doing the acquisitions, and they have a very long runway, especially in the US, where they're basically buying smaller operators, and they'll have a central dump or disposal place, and they can add incremental value right away. So GFL has been in our portfolio, I think now for 5 years, just after they came out being public, and we think it's a wonderful long-term company.
Is it a competitive space?
It's really more oligopolistic. They're, I think, number 4 or 5 in North America as waste management firms. And when you say competitive, they're one of the big guys buying the small guys. For the small guys, it's a tough business. But once you can get scale, which GFL has, you can make a lot of money.
Okay. All right, let's go to Ray on the line in Hamilton, Ontario. He's got a question today. Hi, Ray.
Hi, how you doing?
Good,
thanks for taking my call.
Go ahead,
Yeah,
Ray.
my question is about the Royal Bank. I have a fairly large position, and I was just wondering about your long-term view, say, over the next 4 to 6 quarters. Thank you very much.
Very specific. Okay.
Oh, 4 to 6
Bank.
quarters.
Yes.
Okay. It's another one we own. Everybody keeps calling in about companies we do own. Royal Bank is probably the best managed bank in Canada, perhaps one of the best in the world. I mean, they're fantastic. They do a wonderful job in Canadian retail, the wealth management, just the regular commercial bank or personal banking. And really where they've made a lot of money these days is their capital markets business, which can be a little cyclical, but they've done another great job there. So when I look at the Royal Bank, this is if you've owned it for a while, especially if you have a lot of capital gains, why sell it? It gives a decent dividend. It's not going to disappoint you maybe over 3 to 5 years. The next 4 to 6 quarters, that's going to be the market that's going to take it up or down. But if you've held it for a while and if you're selling it and you have a lot of capital gains, which most people with Royal Bank do, hold on to it. Take out money from the dividend, and Royal Bank will do well, perhaps over the next 12 or 16 quarters.
Okay.
So how's that?
And about a 3% dividend there for Royal Bank. Okay, let's go to Mario, who's in Toronto. He's got a question. Hi, Mario.
Yes, good afternoon. I would like to find out what's going on with Cameco, because lately it's been lose a lot of money. I don't know if I got to get out or what. Can you talk about it, please?
Thank you for the question. I'm not sure if you can speak specifically to Cameco or do you want to speak to Uranium?
Really with Cameco, I'm going to tell you I don't know enough about it I'd be dangerous talking about it, just the little I know. But Cameco really, with the price of uranium skyrocketing in the last while, and then uranium, once again, is a commodity where we can't forecast it as well. But what's going on with uranium, with AI buildouts, everybody's looking to forecast more and more nuclear power plants. I'm being a little trite and facetious here, but when you look at it, Cameco is really going up with the price of uranium. What they're doing themselves, I can't really tell you much about Cameco, but uranium seems to be a commodity that has a lot of underlying strength to it because of future expectations of how AI power plants are going to be built out and run. Even small nuclear reactors in the oil sands to get the oil out. And nuclear is something that is definitely going to play a bigger part in our lives in energy going forward.
Okay. Mario, I hope that is helpful for you. Let's go to Peter. He is in Niagara with a question. Hi, Peter. Peter, are you there? Okay, let me give him one more shot. Peter,
Okay.
Peter, are you there? Okay.
Yes. Hello. Can you
Hi,
hear
what's
me?
your question?
Hi. My question is on CP Rail. I've done a lot of research on it. Price seems very cheap. Can you give me your opinion? And Marella, can you please give me the street consensus? Thank you.
Okay, let me see if I can find the street consensus, and let's talk about CP Rail. A lot of the transportation sectors has been pushed down this year. What's your take on the rails?
In the rail space, we only own one rail, and it's CP. So another company we own. We think CP is the best in the space. You're looking at a company that really has that interconnected railway between the U.S., Mexico, Canada. It's been great since the Kansas City pickup. But what you're seeing is the stock price has really been lagging. And as you can see, think about tariffs and where tariffs, I guess the threat of tariffs come in, the threat of tariffs don't, it almost follows that chart as well. So what you're really going to see with rail, and the underlying business is doing fairly okay, but I think you're going to have to see a little bit of certainty on the trade front, which we may never get, but somewhat on the trade front to start pushing CP up. But I don't think it's bad to hold it now as we do.
Did you trim any, or have you bought in any since the dip? Where have you held it for a long time?
We've held it for about 3 years or so, and we really haven't bought any more in the dip. Once again, in this marketplace where you face a lot more macro uncertainties, it's always hard to commit fresh cash when it's a macro uncertainty versus something in the business where you can get a handle on. So CP is doing great as a business. It's just they're facing the macro uncertainty we hear about every day in the news.
Okay. And he had asked about the consensus rating. So I've got 28 buys, 6 holds, 0 sells. If that is informative for you, Peter, I hope that helps. Let's go to Dallas, who is calling today with a question. Hi, Dallas.
Yes, Tim, the question's on Amrice cement manufacturer. Mm-hmm. Do you think they would be a benefactor of all the anticipated infrastructure spending that's supposed to happen in the U.S.?
Definitely so.
Tell me a little bit about the company.
Sure. Amrise is actually newer on the marketplace, and we own it. It was a spin-off of Holcomb, which is the large Swiss cement maker. But Amrise is better known as Lafarge North America, or the core of its business, which is great. They also do some roofing as well. But it's really, it came out, I think if you have a chart, I'm going to say, what is it, about $47 now. And it came out perhaps in May or June as
You're
a
right,
spin-off.
$47.45 is where it is today.
Okay, and what you're looking at is, yes, this will be a great company to ride the infrastructure wave, and you're getting it fairly cheap. The metrics don't look cheap, but because it was spun off and the way it was done, it has a lot of room to run going forward. The interesting thing as well is the CEO of Holcomb in Switzerland actually is now the CEO of Amrise and kind of went to North America to the smaller entity and put his own money in as well. So you know that there's a lot of commitment from management to move this forward.
Got it. Okay, we are going to take a quick break. We will be back with Tim Regan, Kingwest Company, in just a moment. Stay tuned. Welcome back. Tim's a new guest with us today, so we have no past picks, but we do want to talk about a couple of things, one of them happening today, and that is NVIDIA will report after the end of the trading day. Lots of eyes on that because it's a bit of a bellwether for the entire sector. We understand that a lot of the tech players have done well, but investors don't seem to be very happy almost no matter what they see. What do you expect from NVIDIA?
Well, I don't know really what to expect. I'll go with the street consensus. But the whole thing is, when we look at the whole tech market, it's the price. These things are priced to perfection, whether it's NVIDIA, Palantir, whoever it may be, Broadcom. And if there's a stumble, they can rocket down 10, 15, 20% in a day. I don't know if that's going to happen, but the expectations are very high. This is a very pricey market. It does remind me of 99, 2000, going through that. And people forget, NVIDIA is a fabulous corporation. Don't get me wrong, a great business, but do we think it's overpriced? Yes. Let me give you an analogy of another stock that was overpriced in 99, 2000. It was called Microsoft. Microsoft didn't regain the high it reached in 2000 until I think 2014 or 15. So you had 14 or 15 years of dead money. Mm-hmm. Now Microsoft's gone on and done well. Reinvented itself with the cloud business, but you know that was before it was just Office and that. So what we're looking at today is, you know, NVIDIA. It's a game we don't want to play because there's too much volatile danger on the downside.
Okay.
And we don't think enough on the upside. We wish we were there in 20 or in 2023, even at the beginning of the year.
Sure.
Because everybody's made a lot of money, but I think it is priced to perfection.
As you know, some investors are looking for the return on AI. They want to see all of this investment in a return before they feel like they can put more money in, and perhaps they're trimming right now. Do you think there are any clear winners yet from that AI race? Has that field started to narrow?
When you say winners in the AI race, I think, you know, you're starting to see a little bit more practical applications or build-outs. NVIDIA and Brookfield did a deal building out AI data centers. That's going to be a huge thing. We talked about the energy involved. So there is a lot going on in that area. Are there any clear winners? Clearly, NVIDIA is a winner, but whether it's worth $5 trillion or $2 trillion today or tomorrow, I don't know. But it will survive and it will be dominant, but will the stock price go down? That's what people are looking at.
As part of that Brookfield announcement, what they said was the build out of the AI data centers and all of the other infrastructure will require $7 trillion of capital over the next 10 years. So it's a mind-boggling number. And, you know, as we mentioned, these companies are, a lot of them, not running debt for this. They have that cash sitting around to build out a lot of this. So it seems like the fundamentals are still there.
They have the cash today, but $7 trillion is a big number. You're going to have to take down debt. Brookfield's going to go and raise funds in an AI infrastructure fund. I know NVIDIA's pledged the money. NVIDIA has done that to some of the other companies as well. But, is this going to look like vendor financing all over again? I don't know. And so it remains to be seen.
Because that was the problem, right? In 1999 and 2000, it was all done on debt.
Well, it was done on debt, but there was a lot of what they'll call vendor financing, if you remember Nortel. And, you're seeing a bit of that now in the AI game as well. So we'll see how everything really pans out in the next year or so. Maybe it takes longer than that, but, AI is definitely here to stay. It's just, can you make money in the stocks, or is this tech bubble of 99, 2000 all over again?
Got it. Okay, we're going to take a quick break. We will let up more phone calls for Tim Regan, Kingwest Company, taking your questions on North American large caps. Back in a moment. Welcome back. Thanks for joining us. We're going back to the phone lines. Alicia is on the line in Ottawa. Hi, Alicia.
Hi, Maria. Thank you. Thank you, team, for taking our call. Our question is about the Brookfield Asset Management or Brookfield companies, whether it's good for registered savings account, education savings account, RESP, for our grandkids who range from 10 to 14 years old. Thank you very much. I hang up and listen to your answer. Thank you
for the question. Brookfield Asset Management more specifically, but if you want to speak to Brookfield in general.
Absolutely. I mean, thank you for that call. We don't own Brookfield Asset Management, but we do own the parent corporation, Brookfield. A little bit of a difference in where you're getting an insurance company and a top company, but we quite like Brookfield Asset Management. One of the differences, too, if you're looking for a dividend, you can get a dividend, more of a dividend from Brookfield Asset Management, and it's more of a pure play on their underlying business. So we think that if you look at Brookfield today, we think that, and I'm sorry, I think 10 and 14, if you can take a 5-year view on this, Brookfield Asset Management should be able to double. We're looking at 5 years is up 140%. It should be able to double in 5 years, and you're getting a dividend as well. I mean, that's what we're really looking for, too. And there's a lot of wind at their back right now with infrastructure. They've been doing some great fundraising. One of the things I'll talk about later is bigger private equity firms are still raising a lot of money where the smaller ones aren't raising anything. And Brookfield's one of the big giants in this industry. And everything they touch seems to turn to gold. So,
so good
absolutely.
For education plan, it's a good investment.
It's a good investment.
Got it. All right. Hope that helps her out. Let's go to Kevin in Ottawa with a question today. Hi, Kevin.
Questions on the TD Bank. It's had some problems in the U.S. I noticed it's kind of topping out right now. I'm just wondering if you would still step in at this price point. Thank you.
Okay, thank you for the question. As you can see, those problems were sort of the end of last year, in the fall of last year, and it's been climbing back pretty steadily since that time, with that dip in April that everybody had. So it's at 114.72 today, Tim, up 45% on the year. Room to grow for TD?
Room to grow. We have it in our portfolio. It is one of our largest positions. Part of that is because we dipped in a little more after the whole money laundering scandal and penalty. And with a run-up of 45%, as you can see, it's done very well. So right now, we still like it. It still trades at a little bit of a gap to the rest of the banks because of the problems. And also being constrained in the U.S. might not be a bad thing. What they're doing is they're still originating loans, packaging them up and syndicating them out. But their U.S. business was getting a return on equity of about 8 or 10%, which isn't that great. So now we're looking at TD perhaps to announce some buybacks, do other things that can actually create value, because they do have the capital for that today. They are overcapitalized. So yes, we like TD.
Not to put you on the spot, but do you remember how long the cap is in place for? It's 5 or 6 years?
Or until they lift it, yes. But it could, look at it, even if it's perpetual, they're redefining their business today and trying to reinvest in in other areas that can earn higher returns on capital.
Got it. Okay, let's get to an email also from Kevin, who is in Coquitlam, BC. I'd like your guest opinion about BlackRock. Is it a buy at this point? Do you invest in BlackRock at all?
No, we don't. But BlackRock is the world's biggest asset manager. Really what you're doing, it's a play on the markets. BlackRock has done tremendously well over time. I'm looking at now it's negative over 1 year. But BlackRock has a long-term hold. We don't own it, but probably great long-term holds. And what you're really getting for this is you're basically buying everything in the world under it. You're buying private equity. You're buying the ETFs that they do on all the equity markets, the debt markets, the credit markets. It's just one big holding company.
Is it volatile? I mean, it looks fairly steady, but
a lot of the asset managers are volatile. Their share prices tend to be higher beta. If you look at the alternative asset managers, they may have funds that go up 12% a year that don't skip a beat. Their share price is all over the map.
So you have to have the stomach for that.
You absolutely have to have the stomach for it. But there's great opportunity if you do.
All right. Okay, let's get to another caller. Todd's on the line. He's in Niagara today. Hi, Todd.
Hi there. Thanks for taking my call. My call is regarding the Mag 7. I heard your take on NVIDIA, and I was just curious as to if you had a pick for the Mag 7, which one it would be and why. PE values aren't nearly what they were in the 2000 bubble, so just like your opinion on that. Thank you very much.
There has been a split with the Mag 7, and some of them are still kind of gaining, and some of them have really been pushed down.
Correct.
And sort of sustained that push down for almost 2 weeks now, I guess, a little bit more. Is there one or two in that group you like?
Yes. I'll just start off by saying this. We're value managers, so we never bought any Mag 7 stocks until March of 2020, when everything was on sale. We bought two. One is Alphabet, the other is Meta. They've done very well since that time frame. A little weak in 22, but they're reasonably priced. They're just gushing cash flow. Alphabet's gushing cash flow today. The one thing, as you can see, look at it really take off when you look at, and there's Meta that's gone down, but Alphabet's taken off in the last number of months too, where some things like Meta have actually dropped quite a bit. But they're both reasonably priced. I don't think they're extremely cheap, but they're, say, between 20 and 25 times earnings, depending on how you want to look at it going forward. And when we look at that, there's a lot of great underlying growth. And as I say, they are making cash like it's going out of style these days. And don't forget, they're spending a lot of their CapEx is on AI. And whether AI works or not, they're still going to be gushing cash from their other businesses.
Let me ask you whether you trimmed at all this year, since you bought a few years ago and these stocks have done so well this year.
We did trim about a year ago, both of them, but as you can see, Alphabet's run way ahead of Meta, so it's a little larger in our portfolio today.
And the other question I had is, at what point do you consider it to be unreasonable for the valuations? Because I'm not sure it's the same for everybody.
Well, what we do is we try to look 2 or 3 years in the future in what cash they can actually earn in the business and how the business is doing. And if we find that it gets either fair value to what we're looking at in two or 3 years or expensive, we'll just jump ship. And right now, at what we're looking at in the next few years is the cash coming into these businesses is going to continue to ramp up.
Okay. We will take a quick break. We'll be back with more of your phone calls and your emails in just a moment. Stay tuned. Welcome back. We have a new guest with us today. Tim Regan is answering your questions. We'll go to the phone lines. Taraver's on the line in Sierra Vista, Arizona today. Hi, Taraver.
Oh, well, hi, and thank you. My question is on Apple, the iPhone maker. Mr. Regan, we all know about Apple. There's almost nothing new. Here's the thing. How do you analyze going forward? Because they haven't really come up with a new product. Forget the Apple Car. That's out of the question. Can they really compound their performance in the next, 3, 5, 10 years? Forget about the stock price, just the business. What do you think?
Okay, so good question. And I have the same questions about Apple when you compare to the other tech companies that have new products in the arena.
Well, I'll give you two answers and talk out of both sides out of my mouth. One is they kind of own that infrastructure, so we all use it. I have my iPhone. We use Apple products every day. They really have us. At the same time, people forget, I'm just going off the top of my head, but I think their top line growth over the last 5 or 6 years is only 5%. That's top line. So really what's happened with the stock price is you saw the multiple go from probably 20 to I think 35 today. It's really multiple expansion, as they call it, and that's not a good thing to bet on. Is Apple a mature company? Absolutely. The market cap of Apple is, I get it confused with NVIDIA. I'm going to say $3 billion now, or is it 3 or 4?
Okay.
It's some crazy number. But don't forget that if you're going to look at it 10 years out as a share price, it will actually have to be double the market cap it is today. So it's going to add trillions of dollars of value in the next 10 years. It's really hard to do because they already dominate where they are. So it doesn't mean that they won't do it. It's just very, very hard to do.
Yeah, the cap's closer to 4 at this point.
Closer to 4.
And they would have to evolve the technology in a big way, which they haven't really done. And they'd have to have a bigger AI play, I think, to really make a move.
Well, they would. And the other thing, too, is if you look at the increases, too, a lot of it's just been price increases. You know, you used to buy an iPhone for $500. Now it's $1,200.
Now it's twice that, more, yeah.
iPads and everything else. And at one point, you know, raise the price enough, people will seek alternatives, even though we're all on the infrastructure. So could Apple do it? Perhaps, but they'd be pulling a rabbit out of their hat to double not the stock price, but the value of their business in the next 10 years.
Okay. Let's move on to Lauren then. She is calling from Wainwright, Alberta. Hi, Lauren.
Hi, how are you?
Good, thanks.
Good. The reason I'm calling, I'm just wondering what your thoughts are on the Vanguard VDY
ETF?
Yeah, and where it's going, and would you guys buy more at this time?
Okay, thank you for the question. We'll pull up the line chart for the Vanguard ETF for Canadian high dividends. Is this one you're familiar with?
I'm not as familiar, but I'm familiar with the high. I can talk about the dividends underlying it. So basically, this is an ETF that buys high dividend yielding companies. The one thing you want to look at, though, with the companies internally, the dividend companies, is that dividend sustainable? So in many cases, you're seeing a lot of high dividend companies that their dividend yield gets higher because their stock price collapses. And that's not a good thing. Now, it's up 20% in 1 year, which is great. But when we talk about different companies that they might put in, perhaps, we talk TELUS, now the yield's 8.7, but the share price is down quite a bit. So just be careful with that. But overall, you're getting safer companies with a lot of cash flow in the marketplace. So I'm not going to say it's a bad place to be, but with dividend-paying companies, and this is an ETF, you just want to watch, are they going to cut the dividend or not? But for people looking for dividend income, especially if they're taxable, these are great vehicles.
Okay. Let's get to one last caller then. Ralph is on the line. He's in Vancouver with a question today. Hi, Ralph.
Yes, hi. Thanks for taking my call. Just a general question, what your thoughts are on gold stocks and gold in general.
Okay. Sure. Thank you for the question. I did have, I looked up spot gold. It's still above the 4,000 mark, so it's come back a bit. What's your take on gold?
The take on gold at our firm, last time we owned a gold company was, I think, 20 years ago. Gold stocks, I was on one Bloomberg show with another anchor, I think in June, and we threw up a chart that showed that Barrick, at the end of June, over a 25, 30-year period, the share price was still under what it was worth 25 or 30 years ago. Now Barrick has soared. Mm-hmm. So what you're looking at is gold going, up. As you can see, that's the gold index, but gold is up, I think, 50% this year, just the spot price, probably for a number of reasons, some of which may be rational, some of which may not be. So we think at these levels, we wouldn't want to touch them with a 10-foot pole. And quite frankly, if we miss out and gold stocks keep running, we're happy because we've seen this story before. If you go back to the gold index and look at it over a 20, 30-year period, it looks pretty ugly. It peaks, it valleys, but it doesn't really go up that much.
Okay. All right, we do have to leave the phone calls there, but when we come back, Tim will share his top picks. That's coming up next. Stay tuned. Join us tomorrow on Market Call. David Burrows on the show, President, Chief Investment Strategist at Barometer Capital Management. He'll take your questions on North American large caps. That's tomorrow. And if you missed Market Call, check out our daily podcast. Find it on iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. Time now for top picks from Tim Regan. His first choice is Strathcona, SCR on the TSX. Strathcona, of course, a resource company, lost its bid for MEG. That sort of got settled in a worked out deal eventually. But what do you like about Strathcona moving forward?
Well, Strathcona is, they've done a tremendous job at rolling up the businesses. Adam Waterous, who's the chair in his energy fund, it's been just a great job in what they're doing. They also made a lot of money in this MEG deal, even though they didn't.
They were a big shareholder, yes.
Big shareholders. They can produce a fairly large dividend. I think one of our analysts was telling me it could be $10 a share. I don't know how that pulls out, but we really think that Strathcona is still cheap because the float of Strathcona is mainly held by the Waterous family and all their entities, and they're planning on selling more so that they'll only have 2/3 of it, not say 85 or 90%. So we think it's still cheap because of that, because it doesn't trade as much. That's going to solve itself. It's going to go with the price of oil. We know that as well. But we're looking out, and if we can just look at, oil staying the way it is, the stock itself is $60. I know that's the price of oil these days, in the next couple of years. So we quite like it as an oil and gas pick, well run. We mentioned CNQ that we have before. Those are two of the three oil and gas companies we have.
Got it. Okay, let's get to your next pick, which is Quebecor. And Quebecor is CBR.B on the TSX. Surprised that this was a pick of yours. Tell me what you like about Quebecor.
It's the only telecom that's growing, actually. People forget Quebecor is really Videotron, and then they got the mobile license. It's the Pelodo family originally. They had the mobile license for Freedom Mobile, and Freedom is really gaining a ton of market share. So they're actually a company that's growing. They're producing about a 3% dividend yield. And we're looking at, with the different growth and what they're doing, is we're looking at a target of about $70 in the next few years. And as you can see, if you looked at other telecoms and overlapped them with Quebecor, you'd see that Quebecor has been the only one rising this year, I think.
Yeah, and they've got the 2.7% dividend is what it looks like, so you are getting some money on that side as well. And Quebecor is, continuing to grow. A lot of the telecom businesses have struggled. We know that. Let's get to your third pick, Blackstone, BX on the New York Stock Exchange. Blackstone Asset Management Company, worth more than $1 trillion?
No, sorry. They manage $1.2 trillion today, over $1 trillion in assets. But once again, we talked a little bit about Brookfield, but we own Brookfield, Blackstone, Apollo, and KKR. The big ones in the States we trimmed a little earlier this year, but we think they're very good buying opportunities now because they're down, all of them are down about 20% in I guess over the course of the year. And with Blackstone, what you're really getting is a host of private equity, real estate, private credit. It's a great management team. A little under half their assets are perpetual capital, so it doesn't have to be paid back right away. They raised about $200 billion in the last 12 months. Now, a lot of private equity, private credit firms, except for the big ones, are struggling to raise assets, but they're still raising. And they have a lot of dry powder, as they call it, about $200 billion, meaning they can throw these at different infrastructure, debt, equity deals. And when you look at the marketplace today, as you see some companies that are fairly decent starting to crater in price, you're seeing private equity firms come in and buying them fairly cheaply. That with the fact that, debt the price of debt is coming down in the U.S., it has been in Canada for a while, leads itself to be, we're looking at Blackstone being about $200 in the next 2 to 3 years. And as a dividend, it's chunky because it likes to pay out of the earnings. And you're looking at about a 4 or 5% over the last 5 or 6 years that they'll pay out in a dividend yield. But it's very chunky. And
you said, so it's a variable dividend.
It's a variable dividend, which is smart because their business is variable. They buy and sell companies. They realize fees on them when they sell them. If they don't get the fees. Why pay out the dividends if we don't have them?
But it hovers around 3 to 4% typically?
It's been about 4% over time. But and so you can normalize it at 4, but there's nothing normal about it. Tomorrow, if they're not actually realizing a lot of these things and not making the performance fees, you may see a very, very, very small dividend. But we have to look out 2 to 3 years on these. I'll leave you with one other thing is if you look at all their different LPs in these companies, they do IRRs of about 12, 13, 14%. The share prices themselves are about 2% better over time.
Okay.
So they're the better investment than the LPs.
Got to leave it there. Thank you so much, Tim, and thank you for joining us on Market Call. We'll see you tomorrow.